Lori Calvasina is head of U.S. equity strategy at RBC Capital Markets. I like just reading your notes. You say, if I'm going to be intellectually honest, and I like that when people say, can I be honest? That makes me think, so what were you doing all those other times we had y'all? But being intellectually honest, Lori, you're neutral. And I think neutral is actually more bullish than you actually are, because your metrics bring you to a fair value of somewhere between 5,100 and 5,270 on the S&P for the end of the year. And we're above that right now.
Hi. Yeah, Joe. And look, I would say over time, I think most of the investors, I would say the people who like me at least would say that they think I'm intellectually honest.
I think you are. But I try
to be. And look, and look, I know nobody likes a neutral call, right? And I've actually been apologizing in some of my client meetings recently and saying, look, I'm sorry, this isn't more exciting, but this is just how I see it. And I think it's fair to say, I think you hit the nail on the head, Joe. When I run through the numbers, if I take my earnings number, I can get to that 5,100 based on the PE assumption, which is based on kind of the consensus view of Fed inflation and 10-year yields, where they're going to be at year end. And my earnings number is admittedly a little bit below consensus. I've not yet updated for this last reporting season. There's still a few companies trickling in, and I've had a more pessimistic view on margins than the bottom-up consensus. So fine, let's look at the bottom-up consensus. That's where I can get you close to 5,300. That earnings number is at 245. Layer it in with the same PE assumption and all those same consensus rate, inflation, and Fed assumptions. That's the range. And look, we do try to tell people our valuation model, it's a compass. It's not a GPS. It's a rough guide. But even with that, I run through all these scenarios. And, if you look at the full version of my report, we have all these stress tests. And these are where those consensus views could go wrong. And then I can come up with systematically lower numbers for the S&P. And so, I have other models I look at. This is one of 5 things in our tool belt. But at the same time, I would be lying if I could sit here and tell you that I can make the math work really easily to come up with a higher number. And I just can't get there right now.
And even in 2025, we don't know. You don't know. That's what you point out. It's even foggier in 2025. So you don't have that to fall. A lot of people fall back on. So, 12% earnings per share gain next year puts us at X. But we don't really know. We don't know anything about next year.
Right. And I'll tell you, the one data point that we do know is that if you look at consensus GDP forecasts, so this is where all the economists around the street think GDP is going to be next year in real terms, it's been tracking about 1.7%. That stat for 2024 is tracking around 2.4. So based on what the economics community knows now, they think that growth is going to slow, not into a recession, but into something that we would term as economic purgatory. So remember, I'm an equity market strategist. Why do I call 1.7% economic purgatory? Because stocks typically go down in that environment. And if you look at how stocks perform the year prior to kind of a 0 to 2% GDP range, it's in the single digits. And so that's the kind of one data point that's out there, and it doesn't look so pretty right now.
It's not going to be helped by, if it is 1.7, that gives the Fed some leeway maybe, I guess, depending on inflation. But that's not going to save the market.
So, we have a 2.6 number for PCE baked into that current, consensus view assumption. That's what's getting us to the 21.5 times trailing PE multiple at the end of the year. That consensus view also assumes 1 to 2 Fed cuts this year and 10-year yields that moved to about 4.19. So that seems like a pretty rosy view. I was listening to my rate strategist this morning in his Fed preview for tomorrow. And basically, he says, even if CPI, comes in a little bit cooler than expected, and we have a really good day on CPI tomorrow, he says it's still going to take time for the Fed to really feel like inflation is on the mend. And so he's still looking for a December cut as the first cut at this point in time. So, and basically he says the clock has been reset after that string of negative CPI prints that we saw at the beginning of the year. And, I don't make the Fed call. I don't make the inflation call. But I think there's a lot of wisdom in the way he's thinking about it right now.
Yeah, you are. You're an exhausted bull, I think. I see it. That's what it's. It's one of the first things you said was you just described that. And people are still pretty complacent. I don't think we're really seeing much bearishness built up yet. So sentiment probably isn't something that could soften the blow either.